Most traders have heard about Fibonacci's or your optimal trade entry, but they don't actually know how to draw them effectively. So in today's video, you're going to learn how to identify your optimal trade entry and trade them correctly. So what are Fibonacci's? Fibonacci's are horizontal lines that indicate where support or resistance are likely to occur. Now, because they're dynamic, it's very important you learn how to draw them correctly. First things first, you want to uncheck all of these other boxes. Chances are they're already checked. Now, the main Fibonacci's you need to focus on is the 618, the 0.5, and the 786. You're going to notice that that range, the 618, 786, and 0.5 is your optimal trade entry. That's ideally where you want to use more confluence like a fair value gap or maybe an equilibrium block in that range paired with the optimal trade entry to get a pretty low risk, high reward trade setup. Now we're going to teach you how to draw them. So first things first, you want to pay attention to where the peak and the trough is in whichever direction you're trading. So for this example, it's currently bullish. For an example, what we're going to do is take the fib from the bottom candle to the top candle. And the reason why we're going to put it at this peak is because this is where price starts to retrace. And then we extend that over. Now, at this given point in time, what we want to do is wait for price to retrace back into this optimal trade entry range. We don't just want to enter anywhere up here and look for continuation. The reason why is because chances are if price does retrace, you're not really going to be able to handle much of that risk. So to minimize that risk, you want to wait for price to pull back into at least the discount range, which is below 50% before looking for continuation in trend. And as you can see here on the left hand example, notice how price retraces back into the 618 level, and then notice where we get our perfect expansion off of, the 786. And if we look at the right hand example, notice price never comes back into discount range. When trades like this form, you don't necessarily want to chase this. And if you are going to trade it, you'd want to trade it off of a lower time frame. Because price is fractal, you could enter off a lower time frame here and you will see Fibonacci levels play out or other POIs to take this into continuation with trend. Now let's dive into a couple live examples. So now if you look here at this candle, we got a lot of expansion coming off of data here. 8:30 data came out and we saw a massive candle to the upside. Now you never want to chase price, and especially not during data, because these are like 20-30 point candles in a minute. So the smartest thing to do would be to take your Fibonacci, draw it from the bottom to the top of the range, and wait for price to retrace back into this range. Ideally, we want the optimal trade entry, which for me would be the 618 or the 786, and then look for continuation up. If we come back here and hit play a couple candles, notice how we get our retracement back down. So now what do we see? We swept internal sell side liquidity and we're pushing back into this fair value gap range. And look at the massive expansion we got off of the 618. That is what you want to see ideally when you are trading fibs. If you're trading longs to the upside, you want to see pretty aggressive price action or buyers step in aggressively to take us back up outside of this range. At this given point in time, I would look to take some calls off of this 618 level or longs, whatever you trade, options or futures, either or. Now I would look to actually use the 786, or you could use the bottom of the order block, which we got our expansion up from, as your stop loss. For me personally, I would like to use the 786. So I'm going to put my stop loss down here. Notice it's above the 2-to-1 risk to reward. So what do I say? We take that setup 100% of the time. Now let's play this out a bit. And notice how we got our expansion up to our price target for over 95 points. That's a really great setup. And notice our risk. Yes, we had a risk of 25 points, but notice what actually occurred. Our stop loss was really only 5 points. So when you pair Fibonacci's with a fair value gap, in this example, they are very powerful. The most important thing is you want to be trading with the trend and identify where your drawn liquidity is. Once you've identified those two and remove all of the motions out of your trades to get a more precise entry where you have to deal with little or no drawdown. Now let's take a look at a bearish example. Currently, we are in a downtrend. If you look back, notice we are not making any higher highs. We're just continuously getting market structure shifts and getting continuation down. So at this given point in time, we've identified that the trend is in fact bearish. What do we want to do? Take our Fibonacci's from the high, take this down to the bottom here because we're trading for the downside, and wait for price to start to retrace. So let's play this out a couple candles and notice where price retraces to. What do we have in this range? We have a 5-minute equilibrium block at discount range. Also, if we were to go to the higher time frame, maybe like the 10-minute or 15-minute, we would have a 15-minute equilibrium block also paired in this range. If we were to go to a higher time frame, we would also have a breaker block. Notice this last down close candle where we got our continuation down from. So we have an equilibrium block on a 5-minute paired with a breaker block as well, which is more than enough confluence already to tell you price is likely to push down from here. So at this given point in time, we would look to short the market or take some puts off of our 0.5 Fibonacci here, stop loss at the most recent pivot, and look down to take out sell side liquidity. So notice here, what do we have? A 3.05 R trade. So let's play this out. Notice how precise our entries are when we use Fibonacci's along with other POIs. Now, we eventually take out our sell side liquidity the following day, and we end up capitalizing on 176 points. This is why optimal trade entries are so powerful. They allow you to get a very precise entry with a really low risk and a very large reward. Yes, our stop loss might have been 58 ticks, but in reality, what did you actually deal with? You dealt with 4.5 ticks. So damn near the moment you enter this trade, you were always profitable from the very start of this trade. I hope you guys found this video useful. Make sure to subscribe, like, turn on notifications, and I'll see you guys in my next video.